Hey, I'm no expert, but I'm going to try to explain how an increase in interest rates is going to have an impact on the housing market and potentially your own lives. So stay tuned. Okay, so in the middle of March, the Federal Reserve increased their interest rates for the first time in years. And the reason they did that is to slow down the economy. Right now, inflation, every second you turn your head, there's some inflation number that's coming at you. Yes, inflation is definitely here, and there's a few reasons for that. We're not going to get into that. But the main reason the Fed, one of their main goals is to keep inflation in check. And one of the main levers they do that is by increasing interest, the cost of credit. And when you increase the cost of credit, it's harder for people to access that credit, and that will slow things down. I had a personal example with a buyer. They were in a multi-counter situation. They didn't want to spend more than $700, but they decided to reach for this house another $20,000 to $720 because of the fact that interest rates are going to increase. And it doesn't take that much of an increase in interest rates to essentially be in the same position if you spent an extra $20,000 today. So here's a great example. If they bought the house for $720,000 and their interest rate was 4.375, let's say that their monthly payment was $3,000. Okay? If they waited and let this house go, and the market maybe dipped a little bit and another one came up, and they were able to get that house for $700,000, all it would take is an increase of the interest rate from 4.375 to 4.625, and they'd have the exact same payment. So 720, 4.375, say $3,000 a month. 700,000, 4.625, $3,000 a month. And what is most likely going to happen as these interest rates start to increase? There is so much pent-up demand out there still for houses that it'll take a while for the increase in interest rates to start to slow down the demand so that the prices actually start to level off or potentially even dip a little bit. But because the interest rates is increasing, the payments essentially are going to either be the same or maybe even increase as the interest rates start to increase and the demand hasn't leveled off yet. So there's probably going to be a little bit more of a feeding frenzy as people start to really realize the numbers that they're looking at, which these clients looked at the numbers and were like, let's buy it now for 20 grand more. Even if the market slows down, the interest rates are increasing and we're stuck at the same, if not higher, mortgage payment. So things are going to slow down in general. Credit's going to get tighter. And again, the whole reason for that is to slow things down, to make consumption not as frantic so that supply can catch up with demand. And that's across all industries. The reason why the Fed has pulled that lever and plans on pulling it 6 more times this year. Talk to you soon. See you on the next one.